I think this is the most important year for Bitcoin that has ever existed. We are probably days away from a series of ETFs being approved. And so this is the moment for Bitcoin to use that old term, cross the chasm and really see mainstream adoption, where our parents and our grandparents understand what it is, can buy it, and then do buy it. And I think that if all of this comes to pass, Bitcoin will be a part of the traditional financial lexicon by the end of 2024. So that is my most anticipated trend of the year.
Today we have Chamath from the All In podcast, giving us his Bitcoin price prediction and how massive institutional capital is about to pour into the crypto market. Chamath believes that the coming bull run will be unlike anything we've seen in recent history. The SEC's imminent approval of the BlackRock Bitcoin ETF application is signaling a massive surge of capital about to come into the space. We've seen many rapid cryptocurrency price rises in the last few weeks, and no doubt investors are eagerly anticipating at least one ETF approval, which will bring massive capital pouring into crypto. Chamath points out that just 1% of BlackRock's portfolio will open this floodgate to the tune of hundreds of billions of dollars in institutional capital. When this happens, he says we'll witness a 400% increase in Bitcoin alone, targeting a $100,000 minimum price. The Bitcoin halving coincides with the timeline for this price, so we could see the biggest crypto surge yet in just a matter of months. Let's get right into the interview with Chamath as he gives us his crypto price predictions and timeline for Bitcoin and what we can expect in the days and weeks ahead.
Where is it going? It's probably going to 100, then 150, then 200,000. In what period? I don't know. 5 years, 10 years, but it's going there. And the reason is because every time you see all of this stuff happening, it just reminds you that, wow, our leaders are not as trustworthy and reliable as they used to be. And so just in case, we really do need to have some kind of, insurance we can keep under our pillow that gives us some access to an uncorrelated hedge.
This is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. What is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. When we were doing a lot of forecasting going into this cycle, here's like a couple of really interesting observations. So the first one is, when you look at this M2 money supply, look how much it's actually shrunk. Now, why that's interesting to me is that you have these two forces that are opposing each other. One is we have these huge deficits. So we're technically still, frankly, issuing a lot of money, right? But then on the other side, we have QT. So when debt rolls off, we're not reissuing it. And the balance of that is still a really constructive thing, where now you can see that, M2 has materially started to shrink. And I think that that's a really positive thing, because now what that does, it combats inflation in a good way. Unfortunately for all of us, it hurts financial assets, which is not so good. I think we've all felt that pain, but the reality is that that's been working. So then, Nick, if you go to the second chart, so what you see now is like, we are in a really decent place with inflation. And if you think about what's going to happen over the next 6 months, it's mostly in the bag. And meaning, we talked about this before, but there's a lag effect on a handful of components, specifically rents, which when you roll them into this inflation rate, you're going to see it really, really turn over very quickly, right? So we know that inflation is falling. It's going to fall even more. The second thing, Nick, the third chart here, is you can see that now validated in these 10-year break-evens. Remember, this was the chart we used to look at when we were like, holy mackerel, something's going to break in November of 21. I think we probably should have just sold everything we had in November 21. We didn't do it, but the point is now we know. And what you see here is the 10-year break-evens are also telling us, okay, guys, we're going to be in a pretty decent place. And so I think the setup is basically the following. There's less money in the system. That's a positive. Nick, if you show the last chart, there's more money on the sidelines. And this is just a picture of, I mean, look at the amount of money in money market funds. 6 trillion and growing. So that's a really positive sign, which is that money will need to find a home.
Once rates drop.
No, even just now, because you're gonna be in a situation where, and I'll get to this in a second, but companies are now starting to perform because they've been able to rebaseline against very, very lowered expectations.
Right. And money managers have to do their job and deploy capital.
And that's something we mentioned, I think, last week, but this is now the beginning of the new fiscal year for the entire mutual fund complex. So that's trillions of dollars that have to get deployed, because even though you pay them a very small fee per year, you're not paying them to hold cash. You're paying them to make decisions and own assets. And then, as you said, Friedberg, the last part of this is now you introduce rate cuts, and that's a real accelerant. Now, more than likely, I think what that means is that markets are set up to do pretty well, equity markets specifically. And so I went and I said, well, how can we see some data that proves that this is happening? And what's amazing is if you look at the performance of what I would call the most risk-adjusted seeking companies, so those are tech businesses that have been absolutely hammered. So what is all of this saying? I think what it's kind of saying is inflation is very much in the rearview mirror. Rates are going to get cut by the middle part of the year. The economy looks like it's going to be a soft landing. It's also good for equities. It's good for us. So it's really interesting, actually. I think we've had a fundamental kind of now change.
The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Chamath asserts this journey is just beginning, comparing the initial years to the current widespread interest and investment, with a giant spotlight on Bitcoin ETFs. Saylor highlights this being a significant development in the financial ecosystem. He also suggests that BlackRock, under the guidance of Larry Fink, will lead the charge in obtaining regulatory approval for a Bitcoin ETF. This move, he contends, will underscore Bitcoin's enduring relevance as an asset and its potential as a hedge against currency devaluation.
My biggest business deal is whatever the Fed decides to do to replace or extend BTFP, the Bank Term Funding Program. Remember that the BTFP, which is what the Fed used to bail out the regional banking system last year, in was it like March or April, it was only supposed to last for 1 year. It's supposed to be a temporary program. But I do not think that the balance sheets of regional banks are healthy enough to survive without this continued liquidity from this program. So I think the Fed's gonna have to do something to either replace the program, extend the program. They're gonna have to do something. And I think that regional banks are still in pretty bad shape with, impaired commercial debt portfolios, and they need this liquidity as long as the yield curve remains inverted. So I think the Fed is gonna try and somehow figure out a program to keep these guys liquid until they can de-invert the yield curve. And I think the Fed's trying to massage all of this into place without there being a recession.
I mean, can you play the clip in 2012 and 13 when it was at 200 and everybody was laughing at me on CNBC every time I would talk about Bitcoin? Where is it going? It's probably going to 100, then 150, then 200,000. And the reason is because every time you see all of this stuff happening, it just reminds you that, wow, our leaders are not as trustworthy and reliable as they used to be. And so just in case, we really do need to have some kind of insurance we can keep under our pillow that gives us some access to an uncorrelated hedge. And it's going to eventually transition to something much more important. But for right now, you're just getting all these data points that prove this thing. It's just the fabric of society is frayed. And until we figure out how to make it better, it's time to just have a little schmuck insurance on the side. And everybody's running in. It's just an incredible thing. I could never have imagined it.
Coin.
It is out of control. Like, look, let's
talk Bitcoin?
Let's talk Bitcoin. 2012, I was introduced to it. I started to accumulate. 2013, I wrote an article. And
so hold on, just so we know and can feel bad about ourselves, you're accumulating it at what price?
Well, my dollar cost average is around 100 and something.
And you've held it, everything you've bought?
Well, at one point, myself and, I was introduced to it by a person. I asked him if I could disclose his name. He said no. But he, myself, and another person, all three of us relatively well known in the Valley, we started, at one point we owned almost 5% of the entire float. In 2013. We've sold, they've sold, et cetera, et cetera. I wish we had kept it all. We didn't. It's fine. But then I wrote an article, and I said, you know what? There's so much asymmetric upside here. This is a thing that either goes to, at the time I said, roughly the value of gold. And at the time, it was about $100 a coin, and so there's very little downside. There's all this asymmetric upside. I said, take 1% of your net worth and buy this schmuck insurance. And it's a schmuck insurance in this kind of very elegant, beautiful way.
I missed the schmuck insurance.
That was at $100, though. What would I actually started hearing from people that I know very well who don't often invest, who are now asking me if this is the time to invest.
Buy the schmuck insurance now.
Here's the thing. This is now a confidence game, right? There is no real utility in this. This is a fantastic, fundamental hedge and store of value against autocratic regimes and banking infrastructure that we know is corrosive to how the world needs to work properly. You cannot have central banks infinitely printing currency. You cannot have folks with, misguided and misdirected monetary and fiscal policy. No. So here's what I would say. The same way that I said in 2013, put 1% of your net worth into Bitcoin, I will put myself out there today. I think this thing is $100,000 a coin, probably in the next 3 to 4 years. And I think it is, in the next 20 years, $1 million a coin. So there you have it. What I'm saying is you could buy the S&P 500 index, buy 99% of that. So if you have $100 to invest, what I'm saying is...
Put $1.
Put $1. And the reason that $1 is so valuable is that it is fundamentally not correlated to the other 99. And just on the off chance that all the people that manage the 99 may not totally know what they're doing, the $1 may actually save us.
The crypto market is poised for a meteoric surge in prices. He illustrates Bitcoin's current undervaluation, drawing in investors and enticing speculators eager to ride the waves of September's price fluctuations in pursuit of profits. Chamath's outlook is fueled by the impending wave of mass adoption, which he believes presents an unparalleled opportunity to get in on the action. He sees the race toward a six-figure price target set to unfold in just under a year. What's more, he highlights the intriguing historical pattern of Bitcoin's value surging 10x with each halving event, hinting that 2024 could catapult Bitcoin from $10,000 to an unbelievable $100,000. He asserts that the promises made by the Federal Reserve and central banks have been hollow, leading to excessive money printing and a proliferation of poor investments. And with the aftermath of the recent inflation surge, Chamath says this will not lead to a return to the status quo. He argues that the economy has spun out of control, with the US facing a mounting debt crisis. Kaiser presents two bleak possibilities: hyperinflation or a deflationary depression. In either scenario, the overall quality of life deteriorates. He notes the absence of viable solutions, indicating an even greater severity of the crisis. Interestingly, he points out how political figures are discussing Bitcoin as part of a potential solution, marking a shift towards a Bitcoin-centric financial framework. What do you think about Chamath's prediction for Bitcoin, the crypto market cap, as well as the institutional capital pouring into the space? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.